There was a study that was done by the New York Fed that found that Americans are borrowing more for cars while borrowing less for houses. And the reason why the statistic caught my eye is because of my strong belief in home ownership, and that is the best value for low and moderate income households to build wealth over a long period of time. I often have said I would want individuals to rent the car and own the home as opposed to owning the car and renting the home. And in a separate report, the Federal Reserve described a link between rising student debt and an acute decline in home ownership, particularly among young Americans. So my question is, what does declining home ownership rates, especially among young people saddled with student debt, say about the overall health of the United States economy?
I think the overall household picture of debt, if I can start with that, is basically a healthy one. There are a couple of areas of concern, and you touched on the main one, which I think is student debt. And there's a growing body of research that shows that students who borrow for their education and wind up not getting the kind of value they thought they would get, so that their incomes are lower than expected, can't pay the debt back. That debt can hang over their economic and personal lives for many years, meaning lower levels of home ownership and other, other sort of measures of economic success. So we're seeing more and more evidence of that as student debt grows.
And just on I guess a different column in the same way, you've identified that debt is also high among low-rated or unrated non-financial firms, and that underwriting has deteriorated in lending to highly indebted businesses. So I'm switching from the individual to the business now, this leverage lending. And obviously we want to encourage prudent lending to American businesses, even those with existing debt. But I don't want to go back to 2008. So does the Fed believe that increased credit risk in the leveraged loan market pose systemic vulnerabilities, particularly in the event of an economic downturn?
So this is an important supervisory focus, and the headline answer to your question is we don't believe it poses systemic kinds of risks, but we do think it poses a macroeconomic risk, particularly in the event of an economic downturn. These are companies that have borrowed in good times and borrowed high amounts of debt, and if there is a downturn, they'll be less able to carry out their roles in the economy, and that may have an amplification effect on a downturn. Our supervision of banks indicates that the banks do not have excessively high exposures to these highly levered non-financial corporations, and also don't have excessively large pipelines of commitments that they've made. Those are two things that they did have before the financial crisis that they don't have now. So the banks, and that's our window into this, is largely through bank supervision. The banks have really changed the way they manage their involvement in this business in a way that puts the risk out in the holder's hands rather than the bank's hands.
So we tried to, and we came up with Dodd-Frank to deal with the mortgage crisis back in 2008, and we try to make sure that we're now watching with reference to living wills and other things to prevent. Do you think we are prepared and we have enough regulators are watching closely enough so that we can avoid leveraged lending ending up being the next bubble that burst and it cause us to have the same kind of financial crisis that we had in 2008?
Yes, so I think our financial system is so much better capitalized and has so much more liquidity. It has a better sense of its risks and a better ability to manage those risks. Stress tests require banks to take a forward-looking, particularly the largest banks, a forward-looking assessment of their capital adequacy. They've also done resolution planning. So our banking system is so much more resilient and so much stronger than it was before the financial crisis, so that it should be able to withstand the kinds of shocks that we're talking about. So if there were, for example, unexpectedly high credit losses among non-financial corporates, then yes, the banks should have plenty of capital and liquidity to absorb those losses. It doesn't mean there wouldn't be disruptions and losses because there would be in the economy, but it would not be, we don't think, the kind of thing that we saw in 2008.